Donald Trump is in shock because German cars have just vanished from U.S. ports, and no one is talking about it. Shipments stopped. Inventories frozen. No warning, no press release. Just silence. On May 23, 2025, while most Americans were still asleep, Donald Trump dropped a trade bomb. A 50% tariff on all European Union vehicles. Effective June 1st. No negotiation, no cushion. Just one ultimatum: build in America or get out. And Germany? They didn't negotiate. They retaliated. Audi froze all US-bound shipments. BMW halted exports. Volkswagen paused rail movements from Mexico. Mercedes-Benz ramped up inventory and then slammed the brakes. Porsche fast-tracked thousands of vehicles to beat the deadline, then stopped. This is not diplomacy. It's economic warfare. The numbers are brutal. The silence is strategic. And what comes next could cripple dealerships, bankrupt suppliers, and spark a global trade meltdown. So why are German automakers pulling out? What's really happening behind the scenes? And how close are we to a full-blown collapse of US-EU economic relations? In this video, let's find out. When the United States announced sweeping 25% tariffs on car imports and signaled that the figure could climb to 50%, German automakers didn't erupt in panic. They didn't issue fiery press releases or threaten walkouts. What they did instead was far more calculated and arguably more devastating to the U.S. auto market. They froze, they paused, they redrew their maps. Volkswagen, BMW, Audi, Porsche, and Mercedes-Benz responded not with a retreat, but with a silent economic maneuver. One that is still unfolding. Each brand recalibrated its U.S. strategy carefully, deliberately, and in coordination. The result? A collective disruption that is reshaping the American luxury auto market in real time. Of all the German giants, Audi was first to act. On April 2nd, before President Trump made his latest tariff announcement, Audi issued a quiet internal memo. The directive was unequivocal: freeze all vehicle shipments to the U.S., effective immediately. No press conference, no marketing spin. Just a halt. Audi's most popular U.S. model, the Q5, is manufactured in Mexico. Its sedans are built in Germany, Hungary, and Slovakia. None are made on American soil. As such, all are now vulnerable to tariffs. As of the freeze, 37,000 Audi vehicles were sitting on U.S. dealer lots. This two-month inventory gave Audi a buffer, but not a solution. To avoid the 25% tariff on any new imports, Audi began holding vehicles at U.S. ports. It calculated that it was safer to wait than to unload. That strategy shows Audi's view. These tariffs could devastate margins, and they must buy time. Meanwhile, Audi dealers have been asked to shift focus from new inventory to clearing what's already available. But once those 37,000 vehicles are gone, Audi must either absorb massive losses or risk pricing itself out of the U.S. market. In contrast to Audi's quiet freeze, Porsche opted for a preemptive strike. Before tariffs took effect, the company shipped an extra 5,000 cars to the U.S., essentially flooding the market to delay shortages. This front-loading strategy helped maintain Porsche's showroom presence in the short term, but it came with risks. Porsche now holds daily strategy meetings to evaluate pricing, logistics, and potential consumer pushback. So far, they have held off on price hikes, but the pressure is mounting. One executive reportedly described the current phase as calm before the storm. You should know that Porsche, like Audi, lacks US-based production, making it fully exposed to tariffs. And with competitors also holding inventory or raising prices, Porsche faces the delicate challenge of maintaining brand prestige without alienating price-sensitive customers. But things don't even stop at Porsche. Volkswagen, Audi's parent company, halted rail shipments from its Mexican plants. This includes major U.S. sellers like the Jetta, Taos, and Tiguan. Vehicles arriving from Europe are being held at U.S. ports, awaiting clarity on pricing and customs. BMW, meanwhile, froze shipments of several German-built sedans, while increasing reliance on its South Carolina plant, its largest in the world. However, even that site isn't immune. BMW recently postponed the U.S. launch of its electric Mini and increased the price of its Mexico-built 2 Series by 4%. Mercedes-Benz adopted a hybrid strategy. First, it surged inventory to U.S. lots in Alabama, Las Vegas, and New York. Then, it cut U.S. division budgets by 25% and suspended future shipment plans. It is the most publicly cautious of the big three. Internally, all 3 brands began suppressing price increases to keep demand steady. But this has already proven unsustainable. BMW was the first to adjust pricing. Audi followed. Mercedes is expected to announce increases soon. Lamborghini and Ferrari are also quietly evaluating their pricing models in anticipation of similar headwinds. And none of this is occurring in isolation. Automakers like Jaguar Land Rover and Mitsubishi have taken similar steps, underscoring that this is not a German-specific issue but a systemic disruption. All are trying to manage the same chaos. Avoid tariffs, maintain market presence, and keep operations lean without sacrificing brand equity. The German automakers' collective pause has had ripple effects. Ports have become holding zones. Dealers are being squeezed. Price forecasts are volatile. Meanwhile, U.S. consumers face rising prices, shrinking options, and delayed deliveries. And Washington? It's watching, unaware that its tariffs have triggered a transatlantic endgame. What happens next hinges on what these automakers do in the coming months. Will they invest in U.S. production? Will they abandon the market? Or will they wait until politics once again changes course? One thing is certain: this isn't a temporary trade spat. It's the beginning of an automotive realignment, and the silence from Germany speaks louder than any tweet from Washington ever could. Before we continue further, tell us, are you enjoying the video? If yes, please like and share the video and subscribe to our channel to watch more videos on the latest news stories on geopolitics, economics, and current affairs impacting your lives. It's true that the ripple effects of Germany's pause strategy didn't take long to reach Washington. But instead of blinking, Donald Trump doubled down. Emboldened by a loyal domestic base and a narrative of economic nationalism, Trump broadened his attack. This wasn't just about punishing foreign automakers. It was about reshaping global supply chains under a singular mantra: make it in America or pay the price. Therefore, it's not limited to only carmakers. Apple became the next target. In early May, Trump issued a stunning demand: relocate iPhone manufacturing to the U.S., or face the same 25% tariffs hitting the automotive sector. The shock was immediate. Apple's stock plunged 4% in pre-market trading. Investors scrambled. Tech analysts warned of severe downstream effects on pricing and innovation. And if Apple, the US-based titan, wasn't safe, who was? Across the Atlantic, panic turned into planning. The European Commission, led by Ursula von der Leyen, began drafting a €95 billion retaliation package. The targets weren't just symbolic. Bourbon, Harley-Davidsons, Boeing jets, Caterpillar machinery, and yes, American-made cars. Europe wasn't bluffing. It was retaliating. The noise from Washington only grew louder, and Berlin had no choice but to listen. Economy Minister Robert Habeck's declaration, "We will not back down," was more than rhetoric. It was a signal. A recalibration was underway. BMW's massive Spartanburg, South Carolina plant, already the company's largest globally, ramped up production to buffer against future volatility. Mercedes-Benz issued sweeping cost cuts across its U.S. division, while Audi and Porsche, traditionally Europe-bound in production, began seriously evaluating American soil as a lifeline, not for growth, but for survival. Even automakers outside Germany started shifting. Volvo, under pressure from multiple fronts, canceled all U.S. orders for its Chinese-built S90 and laid off 5% of its South Carolina staff. BMW postponed its electric Mini launch, knowing any investment could become obsolete overnight. Porsche quietly began blueprinting alternative production plans. The consensus across boardrooms: build resilience or bleed out. But while executives planned, the pain hit the ground. U.S. dealerships, usually buffered from the chaos of global trade, became frontline casualties. Inventory shortages began showing in May. Pre-orders were delayed. New stock wasn't arriving. A Porsche Macan priced at $52,000 in April now comes with a 10% premium, if it's available at all. A BMW 3 Series, once abundant, now sits on a 3-month wait list. Dealers slashed ad budgets, froze recruitment, and began contingency planning for a summer of unpredictable supply and demand. American consumers, too, were caught in the middle. Choices narrowed, prices surged. Premium brands began subtly adjusting financing terms to mask sticker shock. And those waiting on new models may be waiting far longer than anticipated. Back in Germany, the economic toll is no longer theoretical. A Munich-based IFO Institute report projected that if the tariffs hold and EU retaliation activates, Germany could lose up to 2% of its GDP. For a country still recovering from pandemic-era slowdowns and energy volatility, that's a hammer blow. 1/6 of Germany's auto sector earnings come from U.S. exports. Losing that market wouldn't just dent the industry, it would fracture it. The stakes now stretch far beyond trade balance sheets. What began as a tariff battle is turning into a test of political will and industrial identity. If Germany yields, it sets a precedent of economic coercion. If it retaliates, it risks mutual damage in an already brittle global economy. What's more, a full-blown trade war between the US and the EU wouldn't just hurt carmakers. It would send shockwaves through aviation, agriculture, tech, and pharmaceuticals. NATO allies would find themselves in economic disagreement, just as unity is most needed amid the war in Ukraine and growing tensions in the Indo-Pacific. A fractured transatlantic economy would embolden rivals like China and Russia, eager to exploit the West's internal divisions. So what happens now? Well, if the US raises tariffs to 50%, Germany will be forced to choose: pump billions into building new factories on US soil or retreat entirely from one of its most lucrative markets. If the EU's retaliation list goes live, Detroit-based automakers like Ford and GM, and even EV leader Tesla, will face punishing new barriers to their European markets. As of now, German automakers are hedging their bets. No full exits, no factory closures, but no expansion either. Audi has frozen shipments. BMW has delayed launches. Porsche is reassessing manufacturing blueprints. Mercedes is quietly tightening its belt. And it seems the crisis for automakers is just getting started. What do you think? Should German automakers abandon the US market entirely to teach Washington a lesson in economic humility? Do you feel Donald Trump is really protecting American jobs or sacrificing them for a nationalist fantasy that's backfiring? In the comment section below, share your thoughts on whether Trump can truly revive US manufacturing or if he is destroying access to innovation from global partners. Do you want to watch more videos like this one? If yes, subscribe to our channel and press the bell icon next to it. We bring the latest news stories on geopolitics, economics, changing world order, and current affairs. Things you need to stay informed. Thanks for watching, and until the next video, stay tuned.